Welcome to Talk Tickers. You are Talk Tickers, a professional earnings goal summarization podcast. On this episode, you are covering an interesting financial topic. What if I told you that on your 73rd birthday, you enter into this forced liquidation contract with the federal government?
Right. Yeah.
And, failing to execute the terms of that contract perfectly could result in an instant 25% wealth tax on your life savings.
It sounds wild, but the irony is that millions of people sign up for this exact contract in their 20s and 30s without ever actually reading the fine print.
Exactly.
You make that very first pre-tax contribution to a workplace plan, and in that moment, you essentially take on a silent partner. The government allows you to defer your taxes, but it is a deferral, It's not forgiveness.
Yeah, I always like to think of tax-deferred accounts. So your 401k, your traditional IRAs, your 403bs, I think of them like a massive multi-lane toll road.
Oh, that's a great way to put it.
Right. You get to drive fast, completely uninterrupted for maybe 30, 40 years. You bypass all the local traffic of, annual capital gains taxes and dividend taxes.
It's a wonderfully smooth ride.
It really is. But eventually, you see the signs on the highway. You hit the toll plaza. And the toll collector at this plaza is absolute non-negotiable.
Yeah.
And they're strictly enforcing this highly complex set of rules.
Yeah, you cannot just wave and drive right through.
No, you certainly cannot negotiate the fee. So our goal for you on this deep dive is to hand you the exact comprehensive map for this toll plaza.
Which you're going to need.
Definitely. We are exploring the intricate, sometimes maddening, but absolutely essential world of required minimum distributions, or RMDs.
Yeah, the rules of the road.
Right. We'll guide you through the precise mechanics of these forced distributions, the steep financial penalties for getting them wrong, the specific legal pathways to fix those mistakes, and, the advanced tax strategies available to actually protect the wealth you've spent a lifetime building.
And that map is just vital right now because, the rules of the road are not static. They've shifted significantly over the past few years.
Yeah, a lot of legislative changes.
Exactly. The framework surrounding retirement accounts has been totally rewritten, which pushes timelines and alters penalties. And, the burden of calculation, aggregation, execution, it falls entirely on you, the taxpayer.
Wow, so no one is doing this for you.
Nope. If you sit back and wait for a clear, simple bill in the mail from the IRS, you are going to be penalized.
Okay, let's unpack this from the very beginning. We need to start with the triggers.
Yeah.
When exactly does this toll plaza appear on the horizon?
Right.
Because for decades, the rule was simple, right? Everyone hit the plaza at age 70 and a half.
Yeah, the classic 70 and a half rule. But now it's a moving target depending entirely on the year you were born.
Wait, really? So it's not the same for everyone anymore?
Not at all. The legislative logic behind moving the age was essentially a recognition of shifting demographics. Life expectancies have broadly increased, and people are just working longer.
That makes sense.
Yeah, forcing people to draw down their portfolios at 70 just didn't make as much macroeconomic sense anymore. So the government created a tiered system based on your birth year.
Okay, walk me through the tiers.
So if you were born between the years 1951 and 1959, the magic age for you is 73.
Okay, 73.
Right. The year you turn 73 is the year you officially enter the RMD system. However, if you were born in 1960 or later, the government has pushed that toll booth a little further down the road.
Okay. To what age?
For that cohort, the starting age is 75.
So if your birthday falls in 1960 or later, you get a couple of extra years of tax-free compounding.
Exactly.
You don't even have to think about this until you hit 75. But once you actually hit that trigger age, we need to talk about deadlines. When does the cash physically need to leave the account to satisfy the government?
The universal deadline for taking a required minimum distribution is December 31st of every single year.
So New Year's Eve.
Yep. You have the entire calendar year to satisfy the requirement, but the funds must be fully distributed, completely out of the account by the time the ball drops on New Year's Eve.
Right.
That is the ironclad rule for every year of your life once you enter the system. But there is one highly specific one-time exception.
Oh, and this exception only applies to the very first RMD you ever take, right? The infamous April 1st extension.
Yeah, exactly. For your very first RMD, so the one for the year you turn 73 or 75, the law allows you to delay taking that specific distribution until April 1st of the following year.
Okay, let's trace the timeline on that.
Sure. Let's say you turn 73 in June of this year. You are technically supposed to take your first RMD by December 31st of this year.
Right, the standard rule.
But the IRS grants you a grace period, allowing you to push that first withdrawal off until April 1st of next year.
I want to spend some time right here because, honestly, I am stuck on how dangerous this grace period actually is for a retiree's tax situation.
Oh, it's incredibly dangerous.
Right. Delaying a tax bill sounds incredibly appealing. It's human nature to just kick the can down the road. But there is a massive mathematical trap hidden in that extension.
A huge trap.
By delaying the first RMD to April 1st of the following year, you don't reset the clock for the second RMD, do you?
No, the clock does not reset. The second RMD is still due by December 31st of that exact same year.
Meaning you're forced to take 2 complete distributions in a single 12-month calendar year.
Exactly. Let's put concrete numbers to this scenario just to illustrate the danger. Imagine you have a healthy retirement portfolio and your calculated first RMD is, say, $80,000.
Okay, 80 grand.
And your second RMD, calculated for the following year, is $82,000. If you choose the April 1st delay, you take the $80,000 in March of next year, right?
Right.
But you are still legally required to take the $82,000 by December of next year.
Wow.
You have just dumped $162,000 of highly taxable ordinary income onto a single year's tax return.
And because our tax system is progressive, stacking those 2 distributions on top of whatever other fixed income you have, like a pension or standard Social Security, that artificially inflates your adjusted gross income, or AGI.
Absolutely.
You could easily catapult yourself out of the 22% or 24% marginal tax bracket and land squarely in the 32% bracket. I mean, you were paying a premium just for the privilege of delaying the first payment by a few months.
Yeah, and the pain extends far beyond just the marginal tax bracket. An artificial spike in your AGI creates a cascade of, secondary financial consequences.
Such as?
The most severe is often the impact on Medicare. Medicare Part B and Part D premiums are means tested through a system called IRAA.
IRMA.
Yeah, the income-related monthly adjustment amount. The government looks at your tax return from 2 years prior to determine your premiums.
Oh, wow. Which means the double dip RMD you take this year will come back to haunt your monthly budget 2 years from now in the form of massive Medicare surcharges.
Exactly. Furthermore, those Medicare brackets operate as cliff brackets.
What do you mean by cliff brackets?
If your income goes even one single dollar over the threshold, you are hit with the entire surcharge for the full year. Stacking 2 RMDs practically guarantees you'll trip over one, if not several, of those IRMA cliffs.
That's brutal.
It is. Additionally, that same income spike will likely cause a maximum 85% of your Social Security benefits to become fully taxable.
So it's just a domino effect of taxes.
Totally. So while the April 1st delay is legally permissible, and it might make strategic sense in highly unusual situations, perhaps if you had massive deductible medical expenses in that second year to offset the income.
Right, edge cases.
Exactly. For the vast majority of people, taking the first R&D by December 31st of the initial year is really the only rational move.
It really is like opting to pay 2 years of property taxes on the exact same day just because the county gave you a 3-month grace period on the first bill. The math just punishes you.
That's a perfect way to look at it.
Now, before we move off the triggers entirely, we have to address the still working exception.
Yes.
Because what if you hit age 73, but you love your job? You're still going to the office every day. The government surely doesn't force you to start draining your retirement accounts while you are still actively earning a paycheck.
It's actually due, with one very narrow, heavily fortified exception.
Okay, what is it?
If you are currently employed, the law permits you to delay taking RMDs from the workplace retirement plan sponsored by your current employer.
Just the current one?
Yes. So if you are 74 and still working full-time at Company X, you do not have to take an RMD from Company X's 401k plan. You can delay those distributions until April 1st of the year after you finally separate from service and retire.
But I've read that business owners get entirely shut out of this exception. What is the actual threshold there?
The threshold is incredibly strict, basically to prevent abuse by executives and founders. You cannot own more than 5% of the business that currently employs you.
Not even 5.1%.
Nope. If you own 5.1% of the firm, or if you're a sole proprietor, this exemption just evaporates. You must begin taking RMDs from your workplace plan at your trigger age, regardless of how many hours you are billing each week.
I need to clarify the boundaries of this shield for the listener because I can see people making a massive mistake here. Let's say I am 74 I work for a large corporation, so I own 0% of it. My current 401k with them is shielded.
Correct.
But I am a chronic career hopper. I have an old 401k from a job I left in 2015. I have a 403b from a nonprofit I worked for in the 90s. And I have 2 personal traditional IRAs at a major brokerage. Does the fact that I am currently working shield my entire financial portfolio?
Absolutely not.
Wow, really?
The still working exemption is not a blanket immunity. It's an umbrella that only covers the specific plan of the specific employer writing your current paycheck.
So everything else is exposed.
Exactly. Every single other tax-deferred account you own, the old 401k, the old 403bs, the SEP IRAs, the simple IRAs, and all personal traditional IRAs, they are completely exposed to the elements. You are legally required to calculate and withdraw RMDs from all of those outside accounts based purely on your age, completely independent of your employment status.
Which opens up a really interesting proactive strategy. If you plan to work well into your 70s and your primary goal is to avoid forced distributions and the taxes that come with them, you should aggressively consolidate.
Yes, exactly.
You would want to roll those old 401ks and outside IRAs into your current employer's 401k plan, assuming the plan administrator allows roll-ins, right?
That is a phenomenal piece of defensive tax planning. By rolling outside assets into the active employer's plan, you effectively pull those exposed dollars under the protective umbrella.
That's brilliant.
It pauses the RMD clock on that consolidated wealth until the day you finally decide to retire. It preserves the tax deferral for years, potentially saving tens of thousands in premature taxes.
Okay, so we have a firm grasp on the timeline. Age 73 or 75, strictly by December 31st, avoiding the April 1st trap and managing the active employment exception. Now we must turn to the math. Because the government doesn't just tap you on the shoulder and say, please withdraw a reasonable amount to live on. There is a highly specific, inflexible formula that dictates exactly how much money must leave your accounts.
Yeah, the architecture of the formula is straightforward, but the inputs require absolute precision. To determine your required minimum distribution for the current calendar year, you take your account balance as of December 31st of the prior year.
Okay, pause right there. The prior year balance rule is where I see a lot of confusion. Let's walk through the logic.
Sure.
If I am sitting down in January of 2025 to figure out my requirement for the year, I don't look at my current statement. I have to pull up the closing statement from December 31st, 2024. Why does the IRS force us to look backward instead of using the current value of the account?
It's entirely an administrative necessity for the enforcement of tax law. The IRS needs a fixed, unmoving target to audit against.
Oh, because the market moves every day.
Exactly. If they allowed taxpayers to use a current balance, the required withdrawal amount would fluctuate wildly every single day with the volatility of the stock market. You could calculate your RMD on a Tuesday, the market drops on Wednesday, and suddenly your calculation is completely wrong.
That makes a lot of sense.
By locking the calculation to the specific closing balance of the prior year end, the IRS creates a static, indisputable number.
And once we have that static prior year balance, we divide it by the life expectancy factor, which implies the existence of actuaries in some basement in Washington drawing up mortality tables. Where do these factors actually come from, and how do we know which one to use?
The IRS publishes 3 distinct life expectancy tables, and selecting the correct one is the first major hurdle of compliance. The vast majority of taxpayers will use the Uniform Lifetime Table.
The Uniform Lifetime Table.
Right. This is the standard default table. You use this if you are unmarried, if you are married but your spouse is not the sole beneficiary of your account, or if you are married and your spouse is less than 10 years younger than you.
The math here is actually quite revealing about how the government views your lifespan.
It really is.
If you look at the Uniform Lifetime Table for someone who is 75 years old, the factor is 24.6. If your prior year-end account balance was an even $1 million, you simply divide $1 million by 24.6.
Right.
That gives you an RMD of $40,650. You are essentially being forced to withdraw a little over 4% of your account that year.
And as you age, the underlying mechanics of the table accelerate the drawdown. When you reach 85, the factor drops to 16.0.
Wow.
At 95, it drops to 8.9. The denominator gets smaller, which means the percentage of your total wealth that you are forced to liquidate and pay taxes on grows substantially larger every single year.
Oh, they're speeding it up.
Exactly. The government is structurally accelerating their tax collection as you near the end of your statistical life expectancy.
I know the Uniform Table covers almost everyone, but I was reading about the second table, the Joint and Last Survivor Table. It seems like the government gives a mathematical break to couples with a massive age gap, What's the legislative logic behind this?
The logic is wealth preservation for a vulnerable surviving spouse.
Right.
You only use the joint and last survivor table if your spouse is the sole primary beneficiary of the account from January 1st to December 31st of the year, and your spouse is strictly more than 10 years younger than you.
Strictly more than 10 years.
Yeah. If you are 75 but your spouse is 60, applying the standard uniform table would force you to draw down the account way too aggressively, potentially leaving the 60-year-old spouse destitute in their later years after you pass away.
That would be a disaster.
Right. So the joint table blends both of your life expectancies, providing a much larger factor. This mathematically results in a significantly smaller RMD, allowing the capital to remain in the account, compounding tax-deferred, to sustain the younger spouse over their longer remaining lifespan.
It is a rare moment of the tax code actually demonstrating empathy for longevity risk. What about the third table?
The third is the single life expectancy table. This is entirely separate from your own retirement accounts. You use this table primarily if you are the beneficiary of an inherited account.
Okay, inherited accounts.
Right. It's based strictly on your individual single life expectancy, generating a different, generally faster drawdown schedule.
So find your prior December 31st balance, select your factor from the correct table, and divide. The arithmetic is middle school level.
Yes, very simple.
But I want to pose a highly practical, potentially devastating scenario for you listening right now. What happens to this static formula when the real world intervenes?
Oh, boy.
Let's say it is December 31st, 2021. The stock market is at an absolute all-time high. My retirement portfolio closes the year at a peak of $2 million. Under the rules, my RMD for 2022 is calculated based on that $2 million.
Correct.
But then 2022 actually happens. We experience a massive bear market.
Yeah.
By the time I sit down in November to actually execute my withdrawal, my account value has plummeted to $1,400,000. Do I get to call the IRS and ask for a recalculation based on my current reality?
The IRS does not care about the current reality of your portfolio.
Not at all.
Not even a little bit. Your required withdrawal is locked in stone based on that high watermark from the prior December. In your scenario, if your calculated RMD was $80,000 based on the $2 million peak, you still must withdraw exactly $80,000, even though your portfolio has evaporated by 30%.
This is what financial planners call sequence of returns risk, magnified by tax law. I am being forced to liquidate a much larger percentage of my currently depleted portfolio just to satisfy a tax bill calculated on phantom wealth that no longer exists.
Exactly. It forces you to sell off shares of stock or mutual funds at the absolute bottom of a market cycle, permanently locking in those losses and destroying the share's ability to participate in the eventual market recovery.
That's terrifying.
Which is why this reality necessitates a massive shift in how you manage asset allocation within your tax-deferred accounts in your 70s. You cannot be fully invested in volatile equities. You must implement careful cash management.
What does that look like practically?
A prudent strategy is to maintain a dedicated buffer of liquid cash or highly stable short-term instruments like treasury bills inside the retirement account, sufficient to cover at least 1 or 2 years worth of upcoming RMDs.
Oh, I see. That way, if the market crashes in October and your RMD is due in December, you aren't forced to sell your S&P 500 index fund while it is down 20%.
Exactly.
You simply distribute the cash buffer you already set aside to satisfy the IRS, leaving your equities untouched to weather the storm. Keep the toll money in the glove box so you don't have to sell the engine to pay the toll collector.
A perfect analogy. Cash reserves insulate you from the rigid timing of tax law.
So we know when the money is due, and we have mastered the math of how much is required. Now we arrive at what I consider the most treacherous part of the entire system, the aggregation puzzle.
Oh, the labyrinth.
Right. Once you calculate the total toll you owe, figuring out which specific accounts that money must physically leave is an administrative nightmare.
The complexity here stems from the fact that different types of retirement accounts operate under entirely different legal frameworks. The IRS rules on whether you can combine or aggregate your RMDs vary wildly, depending on the specific legal structure of the account you hold.
Let's build a matrix for the listener, going account by account. Let's start with the most common. Individual retirement accounts. Traditional IRAs, SEP IRAs for small business owners, and simple IRAs. What are the aggregation rules here?
For the IRA family, the rules are remarkably generous and flexible. The IRS treats all of your personal IRAs as a single collective pool of money for distribution purposes.
So I can group them.
Yes. The mechanical process works like this. You must calculate the exact RMD for every single IRA account separately. You do the math for IRA A at your bank, IRA B at your brokerage, and IRA C where you hold alternative investments.
Okay, so 3 different math problems.
Right. Then you add those 3 calculated dollar amounts together to arrive at your total global IRA RMD requirement. Once you have that single massive number, the law allows you to withdraw that total sum from any one of those IRAs or any combination of them you choose.
The strategic value of this cannot be overstated. Let's say I have a self-directed IRA that is heavily invested in physical, illiquid commercial real estate.
Right, very illiquid.
I can't easily sell a bathroom in an office building to satisfy a $10,000 tax requirement.
Yeah.
But I also have a second, standard, traditional IRA filled with liquid cash and index funds. I can calculate the RMD for the real estate IRA, add it to the RMD for the cash IRA, and then pull the entire combined total exclusively out of the liquid cash account. The real estate remains entirely untouched.
Exactly. It grants you the power to choose which assets to liquidate based on market conditions and your portfolio strategy rather than arbitrary account balances. However, there are 2 impenetrable walls within this aggregation rule that investors frequently crash into.
What are they?
First, the spousal wall. Your IRAs and your spouse's IRAs exist in entirely separate legal universes. You cannot aggregate them.
So I can't pull my RMD from my wife's IRA.
Absolutely not. You cannot calculate your RMD and pull the cash from your spouse's account. Second, the inheritance wall. You cannot mix inherited IRAs with your own contributory IRAs.
That makes sense.
If you inherited a traditional IRA from your father, the RMD for that specific account must be calculated separately and withdrawn from that specific inherited account. It cannot be aggregated with your personal retirement funds.
Okay, so personal IRAs can be grouped together. What about 403B accounts? We have millions of teachers, nurses, and nonprofit workers listening who have spent careers building these balances.
403B accounts operate under their own parallel aggregation rule. If you spent 30 years in the nonprofit sector and left behind 3 different 403B accounts at 3 different universities or hospitals, you can aggregate them.
So just like IRAs.
Almost. You calculate the RMD for each 403B, sum them up, and pull the total from whichever 403B has the most liquidity. But the critical limitation is that you cannot cross the stream.
Don't cross the streams.
Right. You cannot satisfy a 403B RMD by pulling extra money out of an IRA. The 403Bs exist in a sealed silo, and the IRAs exist in a separate sealed silo.
I can already see the administrative burden building. But let's look at the corporate world. What are the aggregation rules for 401ks and government 467B plans?
This is where flexibility dies.
Oh, no.
For 401ks and 457Bs, aggregation is strictly legally prohibited. Every single employer-sponsored account is an island unto itself.
Why is that?
The reason lies in ERISA law and the fact that these are individual trusts managed by specific corporate plan administrators who have fiduciary duties only to their specific plan.
Ah, I see.
Therefore, if you have a 401k from a job in your 30s, a 401k from a job in your 40s, and a 401k from your final career stop, you cannot combine them. You must calculate the RMD for account A, and you must withdraw that exact amount from account A. You must do the same for B and the same for C.
I want you to picture the reality of this. If you have had a modern, scattered career, you worked 10 years in the private sector, leaving behind a 401k. You spent 5 years working for a university hospital, leaving a 403b. You worked for the state government for a decade, leaving a 457b. And you maintain 2 personal IRAs on the side.
A very common scenario.
Right. You reach age 73. Suddenly you are not enjoying retirement. You are acting as a part-time compliance officer. You are managing a spreadsheet with 5 different account silos. Some allow aggregation, some strictly forbid it, but all of them share the exact same December 31st deadline. It is a labyrinth of paperwork, phone calls to different custodians, and multiple tax forms every single year.
It is a systemic trap for human error. A missed form, a delayed processing time at one brokerage, or a simple misunderstanding of which account can aggregate with which inevitably leads to a failure.
Which is why we talk about consolidation.
Yes. This is why financial professionals almost universally recommend the consolidation strategy. Long before you hit your RMD trigger age, ideally the moment you fully retire, you should execute a comprehensive financial cleanup.
How so?
The most efficient maneuver is to execute direct rollovers, moving all of those old scattered 401ks, 403bs, and 457bs into one single master traditional IRA.
Or if you are a retiring federal employee or military member, rolling everything into the thrift savings plan, the TSP, which acts as a phenomenal master account.
Precisely. If you execute those direct rollovers before December 31st of the current year, you achieve administrative zen.
Administrative zen. I love that.
Well, it's true. On the critical December 31st measurement date, the balances in all those old scattered accounts drop to zero. The following year, you are left with only one single RMD to calculate, manage, and withdraw from that one master account. It turns a massive multi-custodian administrative headache into a single, automated 10-minute transaction once a year.
You are essentially cleaning up your financial closet before the IRS inspector arrives. And you absolutely must clean it up, because if you don't, and the complexity causes you to make a mistake, if you miscalculate a formula, forget a December deadline, or accidentally try to satisfy a 401k distribution from an IRA, you enter the danger zone.
The danger zone is real.
Let's discuss the penalties, because the consequences for failure here are not just a slap on the wrist, they're historically severe.
The penalty for missing an RMD, or for taking even $1 less than the required calculated amount, is a 25% excise tax on the shortfall.
25%.
Yes. To put the magnitude of that into perspective, if your calculated RMD across your portfolio was supposed to be $100,000 and you simply forgot to execute the trades and take the withdrawal, the IRS penalty is an immediate $25,000.
We must clarify for the listener that $25,000 is just the penalty. It is a pure fine. It does not replace the tax you owe. You still eventually have to withdraw that $100,000 and pay your standard 24% or 32% ordinary income tax on it.
Yeah.
The government is essentially confiscating half the value of the distribution.
It is punitive by design. Now, listeners who have followed financial news for years might be confused because historically you always heard people talk about the terrifying 50% RMD penalty.
Yeah, I remember the 50% rule.
It's important to contextualize this. For decades, the penalty was a staggering 50% of the missed amount. It was arguably the most draconian, disproportionate penalty in the entire United States tax code.
That's insane.
It was. But recently, recognizing that a 50% confiscation was excessively punishing to elderly taxpayers who often just made honest administrative errors, Congress passed legislation reducing the penalty to 25%. While 25% is still a massive blow to a retiree's capital, it is mathematically survivable compared to the old regime.
The legislation also introduced a correction window that can lower the pain even further, right? How does that work?
The law incentivizes taxpayers to self-correct quickly. If you realize your mistake and you take the missed RMD and file the proper corrective paperwork within the correction window, which is statutorily defined as generally within 2 years of the missed deadline, the penalty is further reduced from 25% down to 10%.
So 10% is the floor if you mess up but fix it proactively.
Right.
But let's build a darker scenario. Let's say someone has been entirely oblivious. They're 79 years old. They never hired an advisor. They didn't know the rules changed. And they simply haven't taken a distribution in 5 years.
A nightmare scenario.
They owe 5 years of accumulated penalties. How far back will the government actually look? Can they just hope the statute of limitations protects the older mistakes?
Relying on the statute of limitations in tax law is incredibly dangerous, primarily because the timelines are elastic depending on the severity of the error.
Elastic how?
Well, the standard IRS audit timeline goes back 3 years from the date you filed the return. Many people mistakenly believe that if an RMD error is older than 3 years, they are safe from prosecution.
But they're not.
No. However, the Internal Revenue Code explicitly stipulates that if there's a substantial understatement of gross income on your return, which the IRS legally defines as understating your tax liability by 10% or by $5,000, whichever is greater, the audit window automatically extends to 6 years.
And missing a typical RMD almost always triggers that $5,000 threshold.
Exactly, meaning the IRS has a 6-year look-back period.
And if they find evidence that you knew about the rule and chose to ignore it?
Then the concept of a timeline ceases to exist. If the IRS determines there was willful fraud or intentional tax evasion, there is absolutely no statute of limitations. They can audit you back to the beginning of time.
I am stuck on the fundamental nature of this penalty. Why is it so high? If I underpay my normal income taxes, the failure to pay penalty is 0.5% per month. Why does failing to take a withdrawal trigger an instant 25% hit?
The severity is rooted in the legal classification of the fine. Legally, the RMD penalty is not a standard income tax penalty. It is classified in the tax code as an excise tax.
Like the heavy taxes placed on alcohol, tobacco, or gasoline.
Precisely the same mechanism. An excise tax is not a tax on income. It is a targeted tax imposed on a specific behavior, or in this case, the failure to perform a required act.
The failure to take the money out.
Right. The foundational agreement of a tax-deferred account is a compromise. The government allows you to compound your wealth without tax friction for decades, under the strict, legally binding agreement that they will eventually get to tax that wealth before you die. Failing to take the RMD is viewed by the IRS not as a simple mathematical error, but as a breach of that fundamental contract. You are hoarding tax-advantaged wealth.
So they hit you with an excise tax.
Yes. And because it is an excise tax, it sits entirely outside your normal Form 1040 income tax calculations. It requires completely separate, standalone tax reporting to resolve, which makes fixing the mistake a procedural nightmare.
Which brings us perfectly to the rescue mission. Because the penalties are so draconian and the rules are so convoluted that even CPAs make mistakes, the IRS actually has a mechanism built into the code to allow you to beg for forgiveness if you make an honest human error.
They do, thankfully.
If you discover you miss an RMD, you do not just write a check for 25% and accept the loss. There is a very specific 5-step legal pathway you must execute to fix the error and formally request a waiver of the penalty.
The IRS recognizes that a 25% or 50% penalty for a clerical error is devastating. They are generally willing to waive the penalty entirely if you can prove the mistake was due to reasonable cause and you take immediate proactive steps to correct it.
Okay, what's step 1?
The sequence of these steps is paramount. Step 1 is the absolute prerequisite. You must withdraw the missed RMD from the account immediately upon discovering the error.
Makes sense. Fix the problem first.
And here is a critical operational warning. Do not commingle this makeup withdrawal with your current year's normal RMD.
Yeah.
If you missed 2024 and it is now 2025, do not just take one giant lump sum for both years.
Oh, interesting. Why not?
Take the missed 2024 amount as a completely separate, distinct transaction. You need a clear, isolated paper trail, a specific receipt, proving to the IRS that you took the exact missed amount to make them whole.
Okay, so the money has left the account. The IRS has their taxable event. What is step 2?
Step 2 is acquiring the correct paperwork, specifically IRS Form 5329. This is the esoteric form used to report additional taxes on qualified plans. But the trap here is the year on the form.
The year.
You must use the historical version of Form 5329 for the specific year the RMD was missed. If you are fixing a mistake from 2022, you cannot use the current 2025 version of the form. You must go into the IRS archives, download the 2022 version of Form 5329, and use the tax rules applicable to that specific year.
Step 3 is where the process requires a bit of psychological trickery and an understanding of how IRS processing centers actually work. We need an ELI 5. Explain it like I'm 5 on how to fill out this specific form to ask for a waiver, because it is highly counterintuitive.
It is entirely counterintuitive. When you look at Form 5329, Part 8 is the section for RMDs. It asks you to list the required amount, the amount you actually took, and the shortfall. The form then instructs you to calculate the penalty on that shortfall.
Right, the 25%.
But when you are requesting a waiver, you do not follow the math instructions. You calculate the penalty as if the IRS has already granted your waiver. On the final line that asks for the actual penalty amount owed, you enter the number 0.
You essentially presume victory on the math line.
You have to, otherwise the processing computer will automatically generate a tax bill, but you must signal to the human reviewer why you entered 0. On the dotted line directly next to the shortfall amount, you must physically write the letters RC, which stands for reasonable cause, followed by the dollar amount of the penalty you are asking them to forgive. This specific coding tells the IRS agent, I know I owe this penalty, but I am invoking my legal right to ask for a waiver.
Step 4 is the actual plea for mercy, the letter of explanation. What actually constitutes reasonable cause in the eyes of an IRS agent reviewing a stack of these files? Because if I write, I forgot because I was traveling through Europe, or I didn't understand the math, that is not going to fly.
Ignorance of the law or general busyness are never accepted as reasonable cause. The IRS is looking for significant life events or administrative failures that were genuinely outside of your direct control.
Like what?
Valid, historically accepted reasons include the severe illness, hospitalization, or mental decline of the account owner or an immediate family member. The death of a family member around the time the distribution was due is almost always accepted. Major natural disasters that disrupted mail or banking services are also valid.
What about the constant changes in the law? The trigger age has jumped from 70.5, 72 to 73 and will soon be 75. Can you blame Congress?
Actually, yes. Confusion over the shifting Secure Act timelines is frequently accepted as reasonable cause, provided you articulate that you made a good faith effort to follow the rules. But the rapid shifting of the legislative landscape caused an honest misinterpretation.
Well, that's good to know.
Another highly effective and common reason is miscommunication or an outright procedural error by the financial institution acting as the custodian of your account. If the bank failed to process the paperwork you submitted or give you incorrect advice, the IRS will generally grant relief.
How do you structure this letter to maximize the odds of an agent stamping approved on it?
Keep it factual, devoid of emotion, brief, and highly respectful. State your name, your social security number, and the specific tax year in question at the top.
Very clinical.
Yes. Explicitly cite Internal Revenue Code Section 4974D, which is the exact legal statute granting the IRS the authority to waive the tax. Explain the reasonable cause in 3 sentences or less.
Short and sweet.
Crucially, state that the shortfall has already been corrected and attach the transaction receipt from Step 1 as proof. Finally, detail the specific systemic steps you have implemented to ensure this never happens again. For example, stating that you have now set up automated recurring RMD withdrawals with your brokerage firm.
Step 5 is the execution. You take the historical Form 5329 showing the RC notation and the zero penalty. You attach your factual letter. You attach the bank receipt showing the makeup withdrawal. And you mail it to the IRS. But here's the key. You mail it as a standalone package to the specific processing center listed in the Form 5329 instructions. You do not staple it to the back of your normal 1040 tax return in April.
Sending it as a standalone package ensures it goes directly to the specific department that handles excise tax waivers, rather than getting lost in the massive machinery of standard income tax processing.
But now you wait.
Once you mail it, you simply wait. The IRS generally will not send you a congratulatory letter confirming they waived the penalty. You will likely only hear from them if they deny the request and send you a formal bill. If you follow those 5 steps meticulously, your odds of relief for a genuine mistake are incredibly high.
So we have covered the defense. We know how to map the toll road, how to calculate the exact fee, how to avoid the 25% trap, and how to beg for forgiveness if we crash. But playing defense is not how you build generational wealth.
No, it's not.
We need to pivot to offense. Because at its core, the required minimum distribution is a massive systemic tax problem. RMDs are taxed as ordinary income at your highest marginal rate. They can push you into a higher tax bracket, trigger the RMAA Medicare surcharges, make your Social Security taxable, and completely strip you of your ability to control your own income narrative in retirement. How do we fight back? How do we beat the bracket creep before we hit age 73?
You cannot wait until you are 73 to solve a problem that begins at 73. You must start managing the tax burden in your 60s. The most foundational offensive strategy is what we call pre-RMD withdrawals, which is essentially the science of tax bracket optimization.
Walk me through the mechanics of a bracket optimization strategy.
The opportunity window opens at age 59 and a half. At that age, the IRS's 10% early withdrawal penalty completely vanishes. You are now legally allowed to voluntarily withdraw funds from your tax-deferred accounts whenever you want.
Okay, so I have full access without a penalty.
Yes. Let's look at a common scenario. You retire at age 62. You decide to delay claiming Social Security until age 70 to maximize the benefit. From age 62 to age 73, you have a massive 11-year gap where your earned income might be near zero. You might naturally be sitting in the incredibly low 12% or 22% marginal tax brackets.
But if I do nothing and let the portfolio continue to compound tax deferred for another decade, the IRS is going to force out a massive RMD at 73. And stacking that huge RMD on top of my maxed out Social Security could easily push me into the 32% or 35% tax bracket for the rest of my life.
Precisely the trap. The optimization strategy involves actively and voluntarily withdrawing funds from your IRA in your 60s, specifically targeting the top edge of a lower tax bracket. You look at the tax tables, you calculate exactly how much headroom you have left in the 24% bracket before tipping into the 32% bracket, and you purposefully withdraw exactly that much money from your traditional IRA. You choose to pay the 24% tax today.
I am aggressively shrinking the total size of the tax-deferred balance while I am in my 60s. By carving away at the principal now, the balance that the IRS uses to calculate my forced RMDs in my 70s is drastically smaller. The forced withdrawals will be smaller, keeping me safely out of those punitive highest tax brackets later in life. I am choosing to pay 24% on my own terms today to avoid being forced to pay 32% on the government's terms tomorrow.
It is the absolute essence of proactive tax planning. You pay taxes when the rates are mathematically most favorable to you, not when the IRS mandates it, and you don't have to spend the money you withdraw.
Really? What do I do with it?
You can take those withdrawn funds, pay the 24% tax, and immediately reinvest the remaining capital in a standard taxable brokerage account. Future growth in that account is taxed at the much more favorable long-term capital gains rates, which are significantly lower than ordinary income rates.
That is a brilliant strategy for liquidity. But there's a second, even more powerful path here, which is the Roth conversion. How does converting to Roth change the RMD narrative entirely?
The Roth conversion operates on the exact same underlying principle of utilizing those low-income years in your 60s to optimize tax brackets. But instead of withdrawing the money and moving it to a taxable brokerage account, you convert those pre-tax traditional IRA dollars directly into a Roth IRA.
But I still pay taxes on it, right?
Yeah, you still pay the ordinary income tax on the amount you convert in the year you do it, strategically filling up your 24% bracket.
But the magic of the Roth IRA is that for the original owner of the account, the concept of a required minimum distribution simply does not exist. There are 0 lifetime RMDs on Roth accounts. None. That money can sit there, compounding tax-free, until the day you die without the IRS ever forcing you to take a dime.
It is the ultimate shield against the toll plaza. By converting, you are permanently, irrevocably removing those dollars from all future RMD calculations. You are securing permanent tax immunity for that capital.
That's huge.
It is. However, utilizing Roth conversions requires navigating a very specific minefield regarding withdrawal penalties. You must understand the 2 separate 5-year rules.
The 5-year rules are notoriously confusing. I want to use an analogy to make this crystal clear for the listener. Let's imagine the Roth IRA is an exclusive nightclub, and to get money out of the club without paying a penalty, you have to get past 2 different bouncers at the door.
Oh, I like that analogy.
Yeah, let's walk through it.
So the first bouncer enforces the conversion 5-year rule. Every single time you convert a chunk of money from a traditional IRA to a Roth IRA, that specific chunk of money gets its own individual timestamp. The bouncer checks the timestamp on your receipt.
Like a code check tag.
Exactly. You must wait 5 full years from the date of that specific conversion before you can withdraw those converted principal funds without facing a 10% penalty. If you do a conversion in 2025 and another in 2026, they each have their own separate 5-year waiting period. But there's a massive caveat here. We're talking about retirees executing this strategy in their 60s. The 10% early withdrawal penalty only applies if you are under age 59 and a half. So if you are 65 and you do a Roth conversion, you can walk right past the first bouncer. You can withdraw that converted principal the very next day without a 10% penalty because your age overrides the conversion 5-year rule.
That is entirely correct.
Yeah.
For retirees over 59.5, the first bouncer just steps aside. But you still have to deal with the second bouncer who enforces the account aging 5-year rule.
The second bouncer?
Yes, and this rule dictates whether you can withdraw the earnings, the growth, and profits that have accumulated inside the Roth completely tax-free.
To get past the second bouncer, you must have had at least one Roth IRA open and funded for a minimum of 5 years.
Oh, okay.
This bouncer doesn't care about individual conversion receipts. He only cares about the date on your VIP membership card. When did you first join the Roth Club?
So it doesn't matter if you are 85 years old. If you lived your whole life with traditional accounts and you just opened your very first Roth IRA 2 years ago, your membership card isn't old enough. You can withdraw your principal, but if you withdraw any of the growth, that growth will be fully taxable.
Precisely. Which is why financial planners beg clients to open a Roth IRA and fund it with just $20, decades before they ever plan to use it. You start the 5-year clock on your membership card as early as possible, so when you eventually do massive conversions in your 60s, the second bouncer is already satisfied, and all future growth is instantly accessible tax-free.
That is a critical warning.
Okay.
We have talked about strategies where you actually want or need the money, either to live on or to convert to a Roth to protect it for your heirs. But what about a third scenario?
Let's hear it.
What if you are exceptionally well prepared for retirement? You have a massive pension, you have plenty of cash in the bank, you simply do not need the money from your IRA to maintain your lifestyle. But the government is still forcing you to take an $80,000 RMD every year, jacking up your taxes for cash you don't even want. Enter the ultimate tax-efficient giving strategy, the philanthropic hack.
Oh, this is a great one. We are talking about qualified charitable distributions, widely known as QCDs. If philanthropy, tithing, or supporting local causes is any part of your life or legacy planning, the QCD is arguably the most powerful, mathematically efficient tool in the entire U.S. tax code for retirees.
Let's walk through the exact mechanics. How does a QCD fundamentally alter the flow of money?
The standard way to give to charity is to take cash out of your bank account and write a check. But if you are over the age of 70 and a half, and note that this eligibility age is significantly lower than the new RMD trigger ages of 73 or 75.
Good point, it starts earlier.
Right. The law allows you to instruct your IRA custodian to transfer funds directly from your traditional IRA to a qualified 501c3 charity.
So the check goes straight from Vanguard or Fidelity directly to the Red Cross, your local church, or the animal shelter. The money never physically touches your personal checking account.
And because the money never touches your checking account, it never touches your tax return. The IRS dictates that the dollar amount of that direct transfer counts entirely towards satisfying your required minimum distribution for the year.
Oh, that's incredible.
But, and this is the magic of the provision, that dollar amount is never added to your adjusted gross income. It remains completely invisible to the IRS in terms of your personal income calculation.
I want to break down mathematically why this is infinitely superior to the old school method of taking your RMD in cash, paying the taxes on it, and then writing a check to the charity yourself. It all comes down to the mechanics of the standard deduction.
It really does.
Let's look at the projected numbers for 2026 based on the sources. For a single filer over the age of 65, the standard deduction is projected to be $18,150. Now imagine your RMD is $10,000. Under the old school method, you take the $10,000 in cash. It gets added to your AGI, increasing your tax liability.
Right.
Then you write a $10,000 check to your favorite charity and ask your accountant to deduct it. But your accountant tells you that because your $10,000 charitable gift is less than the $18,150 standard deduction, you're just going to take the standard deduction anyway. Itemizing the charity provides no additional value.
The math is brutal. You paid full ordinary income taxes on the $10,000 RMD withdrawal, and you received exactly zero additional tax benefit for making the charitable gift. It is wildly inefficient.
But if you use the QCD mechanism for that exact same $10,000 gift, the money flows directly to the charity. It never hits your AGI. You avoid the taxes on the $10,000 entirely, and you still get to claim the full $18,150 standard deduction against your other sources of income, like your pension.
It's fantastic.
You get a guaranteed dollar-for-dollar tax benefit, regardless of whether you itemize deductions or take the standard deduction. Plus, because your AGI stays artificially low, it protects you from the IRMAA Medicare surcharges and keeps your Social Security from becoming taxable. It is a triple win.
It's the best tool out there. The limits on this provision are also quite generous and are now indexed for inflation. For 2026, an individual can donate up to $111,000 per year using a QCD.
That's a huge limit.
Yeah. And if you are married filing jointly and you both have IRAs, you can each do $111,000 from your respective accounts, removing a massive $222,000 from your combined taxable income. Additionally, legislation recently introduced a new provision allowing you to use up to $55,000 of your annual QCD limit for a one-time irrevocable donation to a charitable remainder trust or a charitable gift annuity.
Wow.
These vehicles allow you to satisfy your philanthropic goals, reduce your RMD burden, and actually generate a lifetime income stream back to yourself from the trust.
This raises an important question, tying back to the complex web of aggregation rules we discussed earlier. Can I execute a qualified charitable distribution straight from my massive 401k or my old 403b?
No. The law strictly prohibits executing a QCD from any employer-sponsored plan, like a 401k or 403b. You can only execute a QCD from an individual retirement account.
So it reinforces the consolidation strategy.
Completely, perfectly reinforces it. If your wealth is locked in a 401k and you want to utilize the immense tax power of QCDs to offset your RMDs, you must first roll that 401k into a traditional IRA. Only then does the QCD mechanism unlock.
It is a massive jigsaw puzzle. The rules are rigid, but if you proactively align the pieces correctly, consolidating accounts to enable charitable hacking, the benefits to your net worth are profound. Now, we have to look past our own lifespans, because the reality of tax-deferred accounts is that the government's claim on the money does not die when you do.
That's a hard truth.
These RMD rules outlive you. They pass on to the next generation. Let's explore the fraught world of inherited accounts and the infamous 10-year rule.
When you pass away and leave a tax-advantaged account to an heir, the legacy impact is immediate and legally binding. We mentioned earlier that original owners of Roth IRAs are immune to lifetime RMDs. They can let the money grow forever.
Right.
However, that absolute protection dies with the original owner. Beneficiaries who inherit Roth IRAs, as well as those who inherit traditional IRAs, are absolutely subject to strict withdrawal rules. The government is willing to wait a long time for their tax revenue, but they will not allow wealth to compound in a tax-free shelter forever across multiple generations.
The rules for beneficiaries underwent a massive seismic shift recently, and we need to explain the history here to understand the current reality. It used to be that if my 30-year-old child inherited my $1 million IRA, they could use a strategy called the stretch IRA.
Oh, the stretch IRA was amazing.
They were allowed to stretch the required distributions out over their own massive life expectancy. They only had to take tiny fractional RMDs for 50 years, allowing the vast bulk of the $1 million to continue growing and compounding tax-free for half a century. It was arguably the greatest generational wealth transfer tool in existence.
It really was. The stretch IRA allowed families to build dynastic wealth inside a tax shelter, but Congress viewed this as a distortion of the original intent of retirement accounts, which were designed to fund the original workers' retirement, not to serve as permanent tax-free estates for their heirs.
They killed it.
They did. To fund the other provisions of the Secure Act, Congress effectively assassinated the stretch IRA. For account owners who passed away after December 31st, 2019, the rules completely changed. Now, the vast majority of non-spouse beneficiaries are legally required to empty the entire inherited account within 10 years of the original owner's death.
The 10-year rule. By December 31st of the 10th year following the death, the account balance must be absolute zero. And to make it even more complicated, depending on whether the original owner had already started taking their own RMDs before they died, the beneficiary might even be forced to take annual distributions during years 1 through 9, in addition to emptying whatever is left at the end of the decade.
The legislative intent is clear. Accelerate the tax revenue. But the practical reality for the beneficiary is a massive tax bomb. Imagine a hypothetical scenario. You are 45 years old in the absolute peak earning years of your career. You are already in the 32% tax bracket.
Okay, doing well.
Your parent passes away and leaves you a $1 million traditional IRA. Under the old rules, you could have taken tiny withdrawals. Under the 10-year rule, you are forced to absorb $1 million of ordinary income over just a single decade.
That's $100,000 a year.
Exactly. You are stacking massive forced distributions on top of your peak career salary. The government is effectively confiscating a huge portion of that inherited wealth through accelerated taxation at your highest marginal rates.
Is there any relief from this? Did Congress carve out any exceptions, or does every single heir face the 10-year mandate?
Congress did carve out relief, recognizing that applying the 10-year rule universally would be devastating to certain vulnerable populations. They created a highly specific legal category called eligible designated beneficiaries, or EDBs. If an heir qualifies as an EDB, they escape the 10-year rule and are still allowed to use the old favorable stretch rules, taking distributions slowly over their own life expectancy.
Who actually qualifies as an EDB? Walk me through the list and the logic behind it.
The primary and most protected EDB is a surviving spouse. Congress has always heavily protected the financial stability of surviving spouses. A spouse has incredible flexibility. They can stretch the inherited RMDs over their own life expectancy, or, even more powerfully, they can execute a spousal rollover.
What's a spousal rollover?
They can take the inherited IRA, retitle it in their own name, treat it as if they had contributed the money themselves, and delay all RMDs until they reach their own trigger age of 73 or 75.
That makes perfect sense. Who else makes the list?
Minor children of the deceased account owner are considered EDBs. The logic is that you shouldn't force a massive tax burden on a child. However, there is a trapdoor. The stretch provision only lasts while they are a minor.
Oh, so when they grow up.
The moment they reach the age of majority, usually 18 or 21, depending on the state their EDB status famishes, the 10-year clock instantly starts ticking, and they must empty the account by their late 20s.
Wow, that's a quick turnaround.
Yeah. The next category includes individuals who are legally disabled or chronically ill. The legislative intent here is pure protection. Congress recognized these individuals need the assets to last their entire lifetimes to pay for continuous care, so forcing a 10-year liquidation would be cruel.
Of course.
Yeah.
That's very necessary.
Finally, the law protects beneficiaries who are not more than 10 years younger than the deceased account owner. The classic example is leaving your IRA to a sibling. If you are 80 and you leave your account to your 75-year-old sister, forcing her to empty it in 10 years when she might live another 20 years, could bankrupt her late in life.
So she gets to stretch it.
Yes. But if an heir does not fit perfectly into one of these narrow, protected categories, most notably healthy adult children, they are stuck with the brutal reality of the 10-year rule.
Which means modern estate planning is no longer just a question of who gets the money. It is a highly complex mathematical puzzle of managing the timeline of when they are forced to take it and what tax bracket they will be in when they do. Leaving a massive pre-tax IRA to an adult child in their peak earning years might be the most tax inefficient way to pass on wealth.
Exactly.
Okay, before we bring this all together, there is one edge case in our research that I absolutely love. It is a brief but fascinating dive into the granular, obscure exceptions of the tax code that reward meticulous, almost obsessive record keeping. I am talking about the pre-1987 403B anomaly.
Oh, this is such a fun one. This is one of the most remarkable grandfather clauses in all of tax law, and it is a perfect study in the value of institutional memory.
Walk us through it.
If you are a teacher, a hospital worker, or a nonprofit employee who contributed to a 403B plan way back before the year 1987, you might possess a hidden superpower. The law dictates that if the institution or the custodian managing that 403B has kept strict, perfect, separate accounting, distinguishing those specific pre-1987 contribution dollars from all of your post-1987 contributions and earnings, those older funds are entirely exempt from the standard age 73 RMD rules.
Wait, really? You don't have to touch them when you hit 73?
Exactly. You are not forced to take RMDs on those specific accounted-for grandfathered funds until you reach the age of 75, regardless of what year you were born. It provides a tiny, protected oasis of continued tax deferral.
That is incredible. The history of every single dollar in your portfolio literally dictates its future tax liability. But the fragility of this rule is what strikes me.
It is incredibly fragile. The exemption hinges entirely on the institution having maintained perfect, uninterrupted records of those specific dollars for nearly 40 years. If those records were lost in a corporate merger, if the plan administrator changed systems in the 90s, or if you ever transferred the account and the funds were commingled, the exemption vanishes instantly.
Just gone.
Yep. The burden of proof is absolute, and if it fails, all of those dollars become immediately subject to the standard RMD rules.
It highlights a broader truth about retirement planning.
Right.
You cannot just set these accounts up in your 20s and forget them. You have to know the DNA of your money. Ignorance of the tax code is quite literally the most expensive mistake an investor can make in their retirement.
The complexity is the penalty. If you do not understand the rules, you will pay for the privilege of breaking them.
Let's distill this entire massive deep dive into the most vital takeaways for you, the listener, as you navigate this toll plaza. First, you must know your exact trigger age, 73 or 75. Calculate the toll accurately based on your prior year December 31st balance to avoid the devastating 25% excise tax, and build a cash buffer to insulate yourself from market crashes.
Absolutely vital.
Second, leverage the power of aggregation. Do not manage 5 separate silos if you can roll them into one master IRA. Simplify your financial life before the IRS forces you to complicate it. And third, do not passively play defense. Play offense.
Be proactive.
Right. Use proactive strategies like pre-RMD withdrawals in your 60s, execute Roth conversions to permanently remove future dollars from the system, and utilize qualified charitable distributions to control your lifetime tax narrative and protect your wealth from Medicare surcharges.
The mechanics are vital, but I want to leave you with a completely different way to look at the future of these accounts. We have spent an hour dissecting the current rules, but the rules are built on a foundation that is fundamentally unstable. The entire premise of tax-deferred retirement accounts relies on the government's willingness to wait for their money.
Right.
But look at the macroeconomic reality. Massive expanding national debt and a rapidly aging demographic where the ratio of workers paying into the system to retirees drawing out of the system is collapsing. If you are 50 years old today planning your RMD strategy for 2 decades from now, you have to ask yourself a provocative question. Will the government of 2045, facing unprecedented fiscal pressure, still honor this deal?
That's a scary thought.
What happens if future legislation decides to means test RMDs, forcing wealthy retirees to draw down their accounts at 10% or 15% a year to accelerate tax revenue? Or what if they apply an entirely different higher penalty tax rate specifically to withdrawals from massive IRA balances?
That is a terrifying but entirely plausible thought. The toll plaza doesn't just have rules. The toll collector has the power to unilaterally change the price of admission while you are already on the highway. Your portfolio is not just a pile of assets. It is a timeline of future unfixed tax liabilities. Every dollar has a destiny, and if you don't aggressively map out the toll roads and build in defensive strategies like Roth conversions today, the government of tomorrow will simply map them out for you at a much higher price. Continue exploring your own financial timeline, track down those old 401ks, and build a strategy that puts you firmly in the driver's seat. Thanks for joining us, and we'll see you on the next one.